Welcome to Talk Tickers, where we break down the earnings you need to know about. Today, we're diving into Sony Group. They just dropped an absolutely impressive Q1 report for their 2025 fiscal year. Now, they actually missed on revenue, but the stock still jumped. We're going to explain exactly why the market is so bullish and what it means going forward. Let's get right into it. Okay, so before we even look at the numbers, let's just set the tone. This quote from Sirkin Toto at Cotton Games really nails the core theme of this quarter. You see, this wasn't just about putting up good numbers. It was about strategic moves that are making Sony's lead in the market even stronger. So what did Sony actually pull off? Well, it was a classic beat and raise quarter. And this is exactly what investors get excited about. It means they beat the profit expectations they were given, and they raised their forecast for the rest of the year. That 1-2 punch sent the stock up over 4% pretty much immediately. Now, this is where the story gets really interesting. Yeah, if you look at the top line, you can see they technically missed on revenue. But, and this is a big but, the market completely ignored it. Why? Well, because they delivered a solid beat on adjusted earnings per share. And, more importantly, look at that operating income line, a 36.5% jump year over year. That is the real story here. And this chart right here, this just drives that point home perfectly. I mean, that jump in operating income wasn't just good, it was a record high for a first quarter. This isn't just growth, it's highly profitable growth, which naturally leads to the next question. Where did it all come from? Well, the answer really comes down to two specific parts of Sony's massive business that are just absolutely crushing it right now. So let's break down these two growth engines, and we'll start with the one everyone loves to talk about, gaming. All right, let's talk growth engine number one, gaming's strategic pivot. The Games and Network Services Division, or G&NS as you'll see it called, is going through this fundamental change in its business model. And believe me, the results are pretty staggering. Just look at that number, 127%. Operating income in their gaming segment absolutely exploded year over year, hitting a new quarterly record. And what's crazy is that this happened even as PS5 hardware sales were kind of stable, up only about 4%. So how on earth did they pull this off? It's all about this concept, engagement economics. See, Sony is successfully shifting away from just selling you hardware every few years. The focus isn't just on selling the console anymore. It's about getting more value out of every single user through high-margin stuff like network services, third-party game sales, and live service games. And the proof is right here in the numbers. The user base isn't just big, it's growing and it's deeply engaged. Monthly active users and total playtime are both up 6%. And that engagement is turning directly into cash, with software sales jumping 23%. And that last point, that's the real kicker. Live service games, think Destiny 2, Helldivers 2, now make up over 40% of their own first-party revenue. That's a stable, recurring cash machine. But believe it or not, the story doesn't end with gaming. Sony has this other powerhouse segment that a lot of people overlook, but it's just as important. So let's dive into growth engine number two, their total dominance in image sensors. The Imaging and Sensing Solutions segment posted a massive 48% increase in operating income year over year. This really shows you the incredible breadth of Sony's tech leadership. They aren't just an entertainment company, they're a core technology supplier to some of the biggest industries on the planet. So what's fueling this? Well, it really boils down to a few key trends. First, the smartphone market is slowly starting to come back. Second, and this is probably more important, we're seeing this big shift to premium phones, which use larger, more complex, and way more profitable sensors from Sony. And finally, you have the rise of the whole creator economy, which is driving huge demand for better video and consumer cameras, another area where Sony is king. Okay, so with two incredible growth engines just firing away, the picture looks pretty amazing. But, a strong quarter isn't just about what goes right, it's also about how you manage your risks. And heading into this report, investors had one major concern on their minds. The question on literally everyone's mind was about the impact of potential U.S. tariffs. The fear was that new tariffs could just decimate their profitability and completely derail this whole amazing growth story. This was, without a doubt, the biggest risk factor heading into the call. But then, management came out and just completely de-risked the whole narrative. They announced that by proactively moving things around in their supply chain, they've managed to knock down the estimated full-year tariff impact from 100 billion yen all the way down to 70 billion. This was a massive, massive positive surprise, and honestly, a real testament to how well they're running the business. So, with the business firing on all cylinders and key risks being managed really well, what should we as investors be watching for next? Let's take a look at the catalysts coming up on the horizon. Okay, there are 3 key dates you're going to want to circle on your calendar. First up, the spin-off of their financial services business in late September. This is huge because it simplifies the story. It turns Sony into a more pure-play tech and entertainment company that's much easier for investors to understand and value. Next, you have a major new game coming in October, which will be a big test for their content pipeline. And of course, the next earnings report in November, where we'll see if these incredible trends are continuing. Which, of course, brings us to our final take. Based on this stellar quarter and what we see coming down the road, what's our prediction for the next earnings call and beyond? Here's what we're thinking. First, if that gaming engagement stays this strong, there is a very real possibility we'll see another guidance raise. Second, we expect the stock to react well after the financial services spinoff, just because the investment case gets so much cleaner. And the key metric to watch, the one thing you have to keep your eyes on in the next report, will be that network services revenue. If that stays strong, it confirms this whole engagement economics thesis is playing out exactly as planned. So, given the powerful performance, the really skillful management of those external risks, and this clear strategic pivot that's unlocking a ton of profitability, our rating on Sony is a confident outperform. The company is just executing on all fronts right now. And as always, this analysis is for informational purposes only. This is not financial advice. Please be sure to conduct your own research before making any investment decisions. Thanks for tuning in to Talk Tickers.